Hello and welcome to this episode of Nothing Ventured with me, Aarish Shah. Today I had with me in the studio Enis Hulli. Enis is general partner at 500 Emerging Europe. In today's episode, we talked about listening to VC podcasts while installing air conditioning, which led to angel investing and ultimately launching a fund.
For 3 years while I was doing heating, ventilation and air conditioning, I was always listening to startup podcasts because I felt like throughout the day, I wasn't actually learning much. Dealing in the construction sites, there's a lot to do. There's a lot of chaos you have to deal with, but at the same time, you don't feel like you're developing yourself, which got me thinking whether I actually want to do this for the next decades to come.
How being risk-averse after his first startup drove him to invest instead. Information and access asymmetries require boots on the ground to invest at pre-seed and seed. How 500 Emerging Europe takes a different approach to the rest of the 500 global family.
What's different about 500 Emerging Europe compared to these other geographies is if you look into Latin America, if you look into Middle East, Southeast Asia, etc., a lot of their success stories are either local or regional success stories. They have X of MENA or Y of Southeast Asia. It's not the case in Emerging Europe.
Population paradox in venture, the culture of equity financing lacking in Europe and especially Emerging Europe. With early adopters, going up the pyramid is tough, you can only go down, and Americanizing your culture as a startup founder in Emerging Europe, whilst also the fact that going from best of breed to best of suite is easier than the other way around. Let's get straight into it. This is Nothing Ventured with me, Aarish Shah, the podcast where I talk to the people behind the stories that make the venture capital ecosystem go round. I've been working with startups from pre-seed to Series C for the last decade, and companies that I've worked with have gone on to realize value and exit or raise funds in excess of $500 million. I really hope you enjoy the episode, and if you have a guest that you'd love to see me have on, or you have a comment on any of the episodes that I've recorded so far, do reach out to me on LinkedIn or Twitter. I'd love to hear from you. Let's get straight into it. Enis, thank you so much for taking the time to be in the studio with me today.
Thanks for inviting me.
No, absolutely a pleasure. Let's dive straight in. So you started angel investing after listening to VC podcasts. Sadly, a little bit before Nothing Ventures time, I think. But talk me through how you made the leap from your more traditional career, selling heating, ventilation, air conditioning in Turkey, to ultimately setting up your own fund. Feels like a bit of a large jump.
Yeah, it was tough. For 3 years while I was doing heating, ventilation and air conditioning, I was always listening to startup podcasts because I felt like throughout the day, I wasn't actually learning much. Dealing in the construction sites, there's a lot to do. There's a lot of chaos you have to deal with. But at the same time, you don't feel like you're developing yourself, which got me thinking whether I actually want to do this for the next decades to come. Hence, I started listening to a lot of different podcasts. I had some money. After 5, 6 p.m. every day, which is when the construction sites would shut down, I would actually go to different incubators or accelerators in Istanbul just to meet with startups, spend time with them. So I would stay until 10 p.m., 11 p.m. just, talking to a lot of idea stage founders. Which then got me thinking I have to find a way into the startup world. Sure, I can become a founder again because I tried that 5 years ago, but I think I'm just too risk averse to do that. And what can I do that's not startup founding, but actually being close to the founders was angel investing. So I did a small checks, 5K to 10K here and there between 2015 to 2016. And then I met with 500. And 500 back then was trying to expand internationally. They had funds in different parts of the world, like Latin America, Mexico, Middle East, etc. And basically I pitched them that Turkey, needs a separate fund apart from the MENA fund.
Yeah. So we're going to talk about 500 sort of global and how it works. And where 500 Emerging Europe sort of fits into that and how different it is. But I'm still super, super curious about, you were a civil engineer, then you went into kind of essentially part of the construction industry, right? Instead of doing these large installations, air conditioning, et cetera, et cetera. I mean, when you went into that industry, did you go into it thinking that, this is going to be the rest of my life? Or was it only once you're in there that you're like, okay, actually, this is not satisfying, whatever urges that you have, whatever itch you needed to scratch? Because it feels like as I say, just like a massive jump from doing that to even angel investing, let alone then kind of raising your own fund.
Yeah, I tried being an entrepreneur in 2011, 2012. We actually raised pre-seed funding, but never were able to raise a seed funding. Moved back to Turkey. I was with Rocket Internet for a while, but then Rocket closed up its Turkey operation. So at this time, 2013, I was super risk averse. All I wanted was to make sure that I'll make enough money And working for someone or somewhere in Turkey with a salary is just, just doesn't cut it. The salary range is not that good. And I always felt like I should. There was this one saying that said that if you don't know what you're going to do for the rest of yourself as a new grad, do some sales, because once you learn that, it's great. And then because my dad also is in air conditioning, my family's from Izmir, which is a bit southern of Istanbul, and he was doing air conditioning business. But I knew the heating, ventilation, air conditioning part of it, so the mechanical engineering part of it more because of my civil engineering degree. That's why I jumped into that, thinking that I can actually make 5 to 10x more than I would otherwise by getting a salary, which is actually what happened. I mean, I think the upside there is capped, but it's easier to make 5x or 10x of what you would have done working for a company, and that's what I did.
Well, this is interesting, right? Because you talked about being a risk-averse entrepreneur, and I want to dig into that a little bit, but you essentially were still an entrepreneur, right? Like just in a different way. So you decided not to found another tech venture, which, okay, fine, is potentially riskier and harder than a more traditional business, let's call it. But you're still in charge of your own fate. You're still essentially running your own game, right?
Yeah, I mean, you are in charge of your own fate, but the downside is fairly protected. Where worst can happen is that you're not making money for a couple of months. There's not that much business risks that you're taking. You're not taking any loans. I mean, eventually what you're doing is you're trying to get these larger contracts, get some portion of that in your bank so that you start buying or employing people. It's pretty much not that risky. But what I did was, and it was my first time living in Istanbul after the rocket internet period. So I would go to certain different business districts, go on Google Maps, search for construction companies, and then these like random addresses or phone numbers would pop up around me. Let's say there's like 50 of them. Then I would call them one by one. I'd be like, hey, can I please speak to your procurement department? I'm doing heating, ventilation, air conditioning.
Lesson to be learned for every single founder out there: pick up the phone.
It was so much fun, man. Like just go to a random cafe, search for whatever, can be anything, and then randomly call people, do some outbound sales, go to them, be nice, etc. And I was 22, 23, so I guess, it was cute for them to see someone 22, 23 hustling, and all I had was a motorcycle. So I would go around the city in Istanbul with a motorcycle, trying to get my first contract so that, I can get the ball rolling.
Yeah. I want to touch on, like, again, this risk-averse entrepreneur, because I'm intrigued, right? So when you launched your startup, clearly you had a feeling that, okay, this is something that you wanted to do. Was it the process of having tried that sort of turned you more risk averse? Or do you think with hindsight, you were always a little bit risk averse and actually that wasn't the right platform for you to kind of take your journey?
I think after that experience, I just felt like I don't know too much.
Yeah.
Operationally, domain expertise, technical expertise, nothing. And then who am I to, shoot for the moons or shoot for the stars, land in the moons? I knew it wasn't going to happen, I guess.
Yeah, it's interesting and the reason I ask is what I realized having tried to build my own tech venture, raised again pre-seed, couldn't raise further, etc., was I don't like being beholden to other people. So taking other people's capital actually was not the right path for me. I like kind of building out on my own steam, bootstrapping. And I'm also okay, I'm 45 now, I'm also okay with not being, a unicorn founder or whatever. I mean, on the assumption that I could even be one of those guys, right? But like ultimately, I made peace with the fact that that isn't me. And actually that's okay, right? Like it's fine to have not less ambition, but your ambition to be in a different direction.
Definitely. And also that also changes with self-confidence. Back then I didn't have the self-confidence, and then a good friend of mine who's actually an entrepreneur, we invested into his company, he then exited. He had this one saying where like, hey, if you leave me anywhere in the world and give me 6 months, I know I'm going to be well off. He had that self-confidence in him just because he's, Harvard grad, studied econ, probably overqualified to whatever ecosystem you put him in. So doesn't matter how rich he's going to get, he knows that he's going to be well off plus, I never had that self-confidence in me until the air conditioning and heating ventilation business. After earning money doing that for 3 years, and at one point we had 25 people in 3 different construction sites, that's when I think I gained that self-confidence. And once you gain that self-confidence, that risk-averseness, kind of fades away.
Yeah, I think, so it's part risk aversion, it's part imposter syndrome, it's part like lack of knowledge. You don't know what you don't know. And I think, a lot of founders, when they're young, even, what they don't know is fine, but they kind of just muddle their way through, and then they bring in other people to kind of help them build the processes or the structure around it. Hey guys, sorry to interrupt. I just wanted to introduce you to our sponsor. This episode is sponsored by Emerge One. Emerge One CFOs partner with VC-backed founders from seed to Series B to manage and raise capital and plan how it should be deployed, controlling cash so that they can do what they do best to scale strategically. You can find them at emergeone.co.uk. That's emergeone.co.uk. Okay, let's get back to the episode. And they're the lucky ones, right? Yeah. There are others who definitely feel that sort of lack of knowledge and don't like trying to plow their way through. And therefore, I mean, I think, the stats show quite clearly that some of the best founders are over the age of 35, 40 or whatever the age is, but certainly sort of, mid, late 30s, early 40s, because they've had the experience, they've learned some of those, those issues. They've understood what they're good at, what they're not good at, where they need other people to kind of come in and assist them, and therefore they thrive.
Yeah, if you look into our portfolio, and we obviously look into that as well, we feel like and there's like a thick wall between the two types of founders. Type A is just like you mentioned, their domain expertise is there. They've actually spent the past 15, 20 years gaining all of that, whether that's knowing the market that they're in, all the stakeholders, potential employees, potential acquirers, all of that. There, you buy what you see. It's their current abilities and potential abilities are pretty much equal to each other, but it's too high. And then there are these other types of founders who are potentially much younger, where they're at the beginning of their career, so they didn't have that steep growth in their career yet, and there's a difference between their current ability and potential ability. And you, as a VC fund, you have to put them into the right environment so that they can seize that opportunity. I think if you look into our portfolio, it would be 50-50, I would say, where like 50% are more A-plus founders, pretty established. You buy what you see, but at the same time, the valuations are obviously much more higher given that they're A-plus and the deals are much more competitive. And then there are these other founders who have a potential to get to A-plus levels, maybe in 2 years, maybe in 8 years. It really depends on how well they position themselves.
You're buying an option essentially on their future.
Exactly,
ability.
And I think there needs to be a healthy balance between the two in a portfolio.
Yeah, I think that makes a whole lot of sense, because equally, I guess, just to round that off, right? Like, you don't want to avoid investing in those younger founders, because ultimately they are often the people that are seeing the trends that others aren't seeing, right? Or are having insights into certain problems, which someone who's been, you get a little bit of myopia, a little bit of blinkered sort of behavior when you've been in an industry for 10, 20 years. You don't see really where the problems are. You just see where, you see where your path has taken you, right? Whereas someone fresh comes 100%. In and sees that problem and is like, actually, there's a much better way to solve this, right?
100%. And sometimes, like, just to talk on what you've just said, some founders, they feel like they have like a 30 to 50% chance of success, but if they become successful, they can easily make, or you as a VC fund can easily make 5 to 10x.
Yeah, which
is great. But then some other ones actually want to do something that only has a 5% chance of working out, but then if it does, it can actually give you like 100x. You know. Yeah. And yeah, I agree with you that the less you know, I mean, ignorance is a bliss, the more for that 5% possibility you can, actually optimize for. And the more you know, then you wouldn't go for 5%. Plus, you don't have a lot of shots at the goal if you've built domain expertise for 15, 20 years. You obviously want to have a venturable outcome, but how much of a multiple that would give to a VC really depends on your on the probabilities that you're seeing and the risk-reward schemes that you're willing to take.
Yeah, and to your point, if you're 40 and you launch a startup, the likelihood of you launching a second one are probably quite low. Like if you have a failure, but even if you have a success. Whereas if you're in your 20s and you have a success, or if you have a failure, the likelihood that you're going to go at it again is probably quite high.
Plus, that type of founder also builds domain expertise along the way, because they know they have to, whereas the other ones are more milking their domain expertise because they've already built it.
Which has limited shelf life, right? So let's talk about 500 global and 500 emerging Europe, right? So it's 500 emerging Europe is part of 500 global in the 500 global family. So talk us through their kind of franchise model at 500 global and how 500 emerging Europe is taking a slightly different path to the typical structure of the other regions.
Sure. I wouldn't call it a franchise model because we're all in the same umbrella, but the way it goes is to do pre-seed and seed investments, you need really strong GPs on the ground because pre-seed and seed, you have to write information asymmetries, but also access asymmetries. On a spectrum of different stages of investing, let's say public investing is all about picking the right companies. It's a picking game. It's not an access game because everyone has the same access in the public markets. Pre-seed investing is like complete opposite of that, where it's not a picking game. It's actually an access and an information game, and you're trying to build these asymmetries on access and information layer so that you can then leverage on those. So to be able to do that, you need people on the ground who are insanely incentivized to build those advantages for you as a fund. And if you're trying to scale your operations globally as a pre-seed fund, you need local GPs who are a lot really incentivized. And for them to be incentivized, you want them to, have their skin in the game, do their fundraising, put their own money behind the fund as well, which then pushed 500 to launch separate vehicles or enable GPs to launch their own separate vehicles in places like Southeast Asia, Middle East, Latin America, etc. And 500 Emerging Europe is a part of that under the group. What's different about 500 Emerging Europe compared to these other geographies is if you look into Latin America, if you look into Middle East, Southeast Asia, etc., a lot of their success stories are either local or regional success stories. They have X of MENA or Y of Southeast Asia. It's not the case in Emerging Europe. If you look into the countries ranging from the Baltics, so Estonia, Lithuania, Latvia, to Poland, all the way till Turkey, those 20 plus countries, there are more than 30 unicorns. None of them are regional success stories. There is no region to speak of. These are 20 countries, none of them venturable in and of themselves, with different culture barriers, language barriers, currency, political issues, etc., which pushes all the entrepreneurs to think global from day one. And then you as a VC fund operating in this region, you have to refine your thesis in a way that's very not like other emerging market funds. And you take a bet on the talent, you take a bet on the founder who's willing to leverage the talent in your region, but then go on and build a global business and potentially compete with all these US unicorns or companies that are based in Silicon Valley, which gives you a more finite number of opportunities compared to other emerging markets. How that correlates to us versus other 500 funds is if you look into other funds that 500 has, you would see more of a larger portfolio size approach where they're hedging their bets, doing tens of, maybe sometimes even more than 100 or 200 investments out of a fund. Not the case with us. So we have 30 investments right now in our fund too. Just given the nature that we're trying to back founders who are going to compete in the global arena, which increases the bar so high that makes the number of opportunities more finite.
Yeah, and not only that, so essentially 500 Emerging Europe acts probably more like a more traditional VC fund, whereas it sounds like in the other regions almost acts similar to a accelerator incubator type model where you are taking, you're essentially creating optionality across a wider spread of businesses. So you may have very, very few venture style outcomes, but you may have one or two, but actually you have a fairly strong kind of chunk in the middle, which are probably going to have decent outcomes, right? And that's where you're creating your advantage. And equally, I mean, to your point, so I think, it's interesting that sort of X of, India or Y of Southeast Asia or whatever, is very much the approach that Rocket kind of took in Europe and elsewhere, right? So taking business models that they've seen work elsewhere and translating them to a local environment. In your opinion, does that model just simply not work in emerging Europe? Can it work?
It works in some markets. I would say if you look into larger markets in our geography, like Poland or Turkey, some verticals are venturable, and you can potentially do 1 to 2 deals per year into these more venturable markets. A lot of them being in the consumer space, less so in B2B. Yeah, sure. And we do take those bets. I would say out of a fund, 10% of our bets are in a way trying to conquer the local market, whether that's in Poland or in Turkey. But in other countries where population is much lower, economy size is much lower, then I don't think it's possible.
Yeah, so a lot of it is down to the dynamics of demography, right? Like essentially, if you don't have enough people, I mean, it's one of the reasons. I mean, we've talked about it a fair amount on this podcast in the past. It's one of the reasons why in the UK and in Europe more generally, and I'm sure we'll talk about this a bit more now, you don't see businesses IPOing or exiting that often here because the market just isn't big enough to get to the sort of numbers and therefore the sort of valuations that make sense from a venture perspective, right?
Yeah, I agree. I call that actually population paradox, where smaller countries like Denmark, Estonia, Israel were creating more unicorns than these mid-market countries like Spain, Italy, or Turkey. Because as the population goes or the economy goes above a certain threshold, you have more entrepreneurs thinking locally. And for an entrepreneur, it is big enough of a market, but for a venture-like outcome, it's obviously not. And to your point, comparing it to Western Europe, if you look into Series B, Series C companies in France or Germany, you would see that 70-80% of their revenue would be local. And that has its own risks, that has its own cap at a certain level. But once you look into a unicorn or a Series B, C company from Bulgaria, from Croatia, from Hungary, for example, You would see either like a pure US approach where 90% is US, or you would see a global approach where like 50% is US and then there's no cap to speak of.
Yeah. So let's talk about that a bit sort of deeper, right? It's difficult to scale in Europe, specifically in emerging Europe, right? So you don't believe there's a talent deficit there. Instead, there's an equity financing deficit, right? And as a result, emerging Europe has to export, therefore become really accustomed to working with Western Europe and USA, which is, as you've described, like a core part of your strategy. So I'd love to get your broader perspective on that topic and how you're adopting, as you call it, the Israeli model for emerging Europe.
Yeah. So talent is really dispersed across Europe, not just emerging Europe, but anywhere you look. I mean, there's a huge talent network effect in the US. I would say talent is located in 3-4 cities, and that's kind of it. And talent want to go to where other talent is.
Yep. Talent and capital always
talent
come
moves,
to the same
exactly.
place. Yeah.
Not the case in Europe. I would say even if you look at small cities with like a couple 100,000 populations, you can see huge outsourcing companies or huge tech companies with remote offices in different cities in Slovenia, for example, or in Croatia. Which actually shows you that talent is there almost anywhere in Europe. I mean, any 50 to 100 kilometer circle that you kind of draw, you would actually bump into a good amount of talent to build a unicorn, because you don't need that many people to build a unicorn. But then what's lacking is the culture of equity financing. That lacks throughout Europe, and more so in emerging Europe. Just historically, compared to the US, I guess UK is the closest to US from a equity financing mindset and maturity perspective. But further east you go, and because of obvious historical reasons as well, or the amount of capital and surplus that's available, that's definitely lacking.
Yeah. I mean, to me, we've talked about this a lot on this podcast, right? That equity gap, especially post Series B, is a massive hurdle, has been a massive hurdle. And I can't remember now the specific numbers, but I believe, and I think it was an episode we recorded with Daniel Glazer from WSGR, the law firm. In 2010, there was about 100 million invested in UK. Fast forward to the 2020s, there's sort of 25 billion, right? So that's already grown, but it's still eclipsed by obviously just the amount of capital in the US. And there seem to be two problems here in Western Europe, certainly. One is, I would say, again, risk aversion, right? So there is less appetite for riskier bets. And these larger pools of capital don't exist to the same extent that they exist in the US. But again, even where they do, are more risk averse than elsewhere, right? So how do you think we get over that gap? Like, what is the solution? Because presumably this has to evolve, right? Like if we keep seeing great businesses coming out of Europe, whether it's Western or Eastern or emerging, one would hope and expect that capital would wake up and start flowing in. Do you think that is likely, or how do you see the pathway to that, I guess?
I think in the whole equities market is driven by power law, and for it to be driven by power law, it really matters how large a company can get. And historically speaking, UK has unicorns. It definitely has unicorns, or Europe has unicorns. Decacorns, a couple. $100 billion companies, not that many of them. Once you don't have those huge examples where anyone who's invested on seed, A, B, C, D, even in the public markets have made, 50x, 100x. I mean, think of buying Tesla stocks or Nvidia stocks. But Europe actually didn't have that many examples of that. But then in a market that's driven by power law, I mean, once you shave that top companies off, what else are you left with? I think that's like because you don't have those examples, it's not driving enough private capital into these markets. And you said that, UK investing has grown from like 100 million to almost 25 billion now, which is huge. That's really driven by, I think, a lot of governments pushing for this through different means. US has been there, done that, way past that. But even a very mature ecosystem like the UK is still very dependent on government putting mechanisms to incentivize people or institutions to invest into this asset class. And now, obviously, when you compare maturity of the UK or France to Eastern Europe, it's a whole different story.
Yeah. So it's interesting because I think, we've talked about the fact that Western Europe is probably 30, 40 years behind where the US is in terms of venture. And I guess, we all treat it as if it was in the same league, as it were. And it is to an extent. Like, there are great businesses that come out of the UK and Western Europe, but where venture as an asset class is still lagging, and therefore I guess maybe it's just a question of enough businesses being built with those large scale outcomes. I guess the paradox again for me is that yes, those businesses will be built, but they'll all go to the US to exit. And that's actually the problem, is like if those outcomes aren't being seen in the markets where they were originally built, then the assumption is that those markets can't sustain them, right?
I think the European startups, European unicorns, were more European back in the day, and now I think they have a larger appetite to go to the US, be global first companies, and then potentially seize that upside potential of becoming a $100 billion business, for example. It's happening more and more. But historically, if you look at 2 decades ago or a decade ago, a European business would have been a European business, wouldn't actually try to outcompete a US competitor. But it is happening now with Eastern Europe. Instead of going through a smooth transition of following the footsteps of Western Europe to maturity, etc., what we're trying to do is just leapfrog to the US market, where we are in the US financing value chain, we are in the US revenue value chain, so that we don't actually have to jump all these hurdles as emerging Europe. So ideally, in emerging Europe, we wouldn't need Series A VCs, B VCs, C VCs, etc., because
You're
good
already in
companies
the US over
make
there.
it to the US anyways.
Yeah.
And I'm seeing more and more in the UK and France and Germany as well, by the way.
Yeah, and there are a few funds which have that as a core part of their thesis.
But not that many of them, which is also interesting. Ever since I've been spending a lot of time in London for the past 2 years and meeting with a lot of the pre-seed funds, seed funds here in London, a lot of them are very, very UK focused, which leaves a gap of entrepreneurs who are trying to make a US first go-to-market approach while employing talent either here or somewhere in Europe. And then there's only a handful of funds that are actually looking into those opportunities.
Yeah, I mean, we've had a couple of on the podcast. One in particular that it's always Hoxton. It's always been a core part of their thesis, right? I guess a lot of other VCs, the assumption is that that's going to happen, but it isn't sort of embedded in their original thesis, if I can put it that way, right? Like they know that for these businesses to scale, ultimately they are going to have to go out to the US and break out, but maybe it isn't what they're looking for day one. Whereas I think funds like yours, like Hoxton's, are saying, well, no, we're not gonna take the risk that you might go to the US. We want to know that you are essentially set up to scale in the US from day one. Day 100 or whatever it is.
And I think your design partners, your early adapters, shape the destiny of your product.
Yeah.
And more mature companies, more companies with higher enterprise budgets you have as design partners, you might be on the tip of the pyramid from a technology maturity standpoint, which is great. But then staying in Europe, I mean, the probabilities of you being able to get those early adapters are just tougher. Most of them are in the US and more predominantly in the Bay Area even.
Yeah, and let's face it, there just aren't that many immensely large businesses in Europe. Plus you have language barriers, you have other sort of cultural issues that you may have to overcome. So let's actually talk about that because in your opinion, when it comes to early adopters, going up the pyramid is tough. You can only go down. So can you expand on what you mean and how founders should think about this problem? And equally, any more general advice to founders in Turkey, the Baltics, and Eastern Europe as they look to build, and what you would say to them today?
So a lot of our portfolio is B2B. So whatever I'm saying is mostly around B2B and SaaS,
Sure.
given that. But what I think is in B2B SaaS, obviously a lot of the companies have this buy versus build decision. And then there's a certain threshold where companies start to buy rather than build. And what you're trying to do is you're trying to find companies who are on that threshold, who are in between whether they want to build or buy, and then they buy it from you. Because chances are those are the ones with the highest budgets, those are the ones with the highest technology maturity, and then you would be shaping their product according to them. And as the market matures, as there's more adoption and market penetration in whatever vertical you're in, you can easily go down the stack, bundle the product, make it more SME-like, go mid-tier enterprise, etc. It's easier to go down. The moment you start mid-tier enterprise or SME and then you try to go up, or the moment you start with companies that are less mature from a technology standpoint, but then you're trying to go for more mature companies, chances are your product is not well suited for that.
It's not robust enough. It's not going to have.
Your engineering team is not well suited for that. And then a lot of the times in that pyramid, after that buy versus build decision, starts companies who want to actually buy best of breed products.
Yeah.
They want to buy these point solutions which are very good. And then down the stack, you start to see more best of suite products, where there are companies who want to buy 5, 6, 7 things bundled to one another, just given their budgets or their maturity. That's what's catered to them. And you can never go from best of suite to best of breed, for example. Best of breed to best of suite is more doable.
Yeah.
I feel like. And for companies starting from Baltics, Eastern Europe, or Turkey, obviously they can find local early adapters, but those are the lower hanging fruits. But optimizing for lower hanging fruits means actually you're optimizing for the short term number of customers, design partners, MRR, whatever you want to call it, which is de-optimizing for long term. That's why we try to push them to the US to find their early adapters in the US. Sometimes those early adopters are in Europe, which is fine. I mean, you can find early adopters in Germany, France, and in the UK. But at the same time, while you're taking that leap of going to an uncharted territory that you've never been before, you're trying to meet with a lot of the ecosystem, potential customers, etc. At least make it count. Don't go to a market where you would have to try to go to another market a year from now. Hence, we push them to the US.
Yeah, I mean, look, it makes a huge amount of sense, even from the perspective of, again, you have not a captured market, but you have an accessible market. You've again, to my earlier point, you don't have language barriers. You have similar legal systems in place throughout the states. Okay, there's some variation from here and from one state to the other, maybe, but again, federal law is the same throughout the US. Whereas obviously in Europe, you have very, very strong differences in legal requirements, which may mean that your product changes from the same business in one country to the same business in another country. You may have to actually tweak, right? So I mean, like, obviously, if we're talking about Europe, GDPR maybe is a good example, where the UK is now theoretically outside of the scope of GDPR, even though it still kind of is, versus Europe, which obviously is very, very much within that framework, right? So then you've got to have slightly different licensing agreements and slightly different product specs and different sort of tech builds for each of those. Whereas if you go to the US, you're basically, if you talk to SAP in Boston, presumably when you go and speak to SAP in Silicon Valley, you're going to have predominantly the same conversation, or you don't even have to have the two conversations because you're capturing all in one, right?
Yeah, and that also ties back to fundraising as well, because the moment you've got a couple of design partners in an ecosystem, you can actually start talking to VCs from there.
Yeah.
And what type of VCs do you want to speak with? Do you want to speak with thousands of VCs that are based in the Bay Area, or do you want to speak with a couple dozen German VCs who actually want you to incorporate in Germany, or same with the UK? And as a company, as a founder, initially what you want to do is, so I think there are two types of companies. Either you get capital and then you try to put substance underneath it, and capital is never the bottleneck in those businesses. It's always almost front loaded, and then you have to put substance underneath it. But if the market turns, then those companies go bust. Fine. But at the same time, if the market doesn't turn, then these are the companies that, make these like mega outlier successes. Whereas in a lot of the companies in Europe, it's the other way around, where you build actual value
substance
to unlock.
First,
it's substance first, and then capital comes after that. And as a VC fund, obviously your incentives are that for your company, that capital should never be a constraint. It should never be a bottleneck. Yeah. Company can fail for a lot of reasons. Capital shouldn't be, one of those.
Yeah. And any sort of final advice for founders building in Turkey, the Baltics, Eastern Europe, from your perspective? What should be one thing they should be focused on? Sounds like it should be on building in the US first, but other than that, what do you think their main focus should be?
Americanizing their culture. That starts initially when they're 2 people, 3 people team, speaking English, going to the US, spending substantial of their time in the US, being able to get US design partners, angel investors, small funds, etc. I think that's critical, because the further away you try to Americanize the culture of a company, the harder it's going to get, basically. Yeah. And we have some companies where they're 15, 20, 30 people, and now they try to Americanize the company by getting a couple of people from, employing a couple of people from abroad, or trying to change the language of the
But there's already a
company.
Cultural clash.
Yeah,
right?
Culture is like, I'm a civil engineer, so culture is like cement, it's liquid once you pour it, but then you have to break it to be able to, re-pour it.
I love that. Culture is like cement. I'm gonna have to roll that one out from time to time. Yeah. Enis, it's been absolutely fantastic having you on the pod today. For our audience, where's the best place for them to find you online? You're on LinkedIn, you're on Twitter. Where can they find you?
Yeah, LinkedIn, Twitter, Instagram, all works. My email is enis@500.co. I'm also a very responsive person. I'm always inbox zero every single night. I want to have a zero inbox policy. I love it, man. If I don't do that, I can't sleep. My wife hates it. I love it.
I'm going to have to take lessons, because I have yet to conquer even one day of inbox zero. I get to like inbox stuff I'll get back to, but never quite zero. But look, Enis, thank you so much for being here in the studio today. It's been an absolute blast.
Thanks for having me, man. This was great.